And especially in real estate, it's a degree of risk. And for your capital stack, on the extreme side, you have, call it single ownership. This is just like a family owned asset. It's just me. On the other side here is called like syndication. But in the middle is something that I like to call a joint venture. It's like an active partnership. I'm an investor, but I'm a commercial real estate attorney, and that's where I'm going to be giving you guys advice to be able to do these things yourself, or do 80% of it yourself and then pass 20% to the lawyer. And I think that's the most effective use of your time right now. So actually for tonight's topic, it's going to talk about partnerships. And what we're going to talk about is how to structure the equity of a single project. Everything is kind of a risk spectrum, and especially in real estate, it's a degree of risk. And for your equity cap, your capital stack, on the extreme side, you have, call it single ownership. This is just like a family owned asset. It's just me. I'm super rich. I'm stroking a 7-figure check and I'm going into this project just myself. I'm the only owner. I'm going to do it. And that's it. On the extreme, on the other side here is called like syndication, $50,000 each to get to $1 million. That's a heck of a lot of work. That's 20,000 in legal fees just to raise the money. And then you're suddenly beholden to 40 different investors that are all calling you about updates on their project because they've invested 50,000 with you and they want results today, tomorrow. But in the middle here is something that I like to call a joint venture. It's like an active partnership. And what I mean by this description is if you just have 2 or 3 people or 4 people come together, everybody is an active member of the LLC. And what I mean is they're active, they're not a passive LP. So this might be people that take on GC responsibility, somebody takes on architect responsibility, somebody takes leasing, somebody takes operations. And then those are the 4 partners that come together with varying levels of capital commitment. Not everybody has to be equal. Doesn't have to be 25, 25, 25% equal splits. They could be 49, they could be 26, 22, something like that. But that's what the topic is, because I think that is the most popular happy medium, where if the total equity needed to start some of these projects is kind of daunting, or even if you can stroke that check for $1 million, $1 million plus, you maybe don't need to, or maybe you shouldn't, just because of diversification, as well as having another partner to share the responsibilities. There's a ton of work involved with, especially new construction. And so even if you have one other partner that you guys split 60-40, 70-30, if you have one other partner, suddenly you've got another resource, somebody to chase down vendors. You have somebody else to go drive by the site. You have somebody to meet with an architect, do all of these meetings that a single investor may not have the bandwidth to do. And so for that and a lot of reasons, I think a joint venture partnership might be one of the best ways to get started, even if the capital is not a concern. The trade-off is control. And so let's get into this PowerPoint. If you want to have a partner, then you're going to have a good operating agreement. And that's essentially the agreement between partners where you decide what are the rules of the partnership. And like that old saying goes, good fences make good partners. And so that's what we have here. So we're going to look at partnerships, conflict resolution, because essentially that's what you're trying to avoid. We're all here to make money. So every decision that we make is really for your long-term interests and to make money. So partnerships. So I talked about, why do they matter? They really help you to scale. They help you to grow and do projects faster that you either don't have the bandwidth for or you don't have the capital. And so that's a lot of reasons why you should do it. We set them up, let's call it a typical LLC. So I'm based in Texas, but we can do this nationwide. You're going to want to form an LLC. You set operating partners that are all active members. You also may all be equal managers. So we recommend a manager managed, and then you name them as managers. And this differs than like a general partnership or limited partnership. So I want you guys to kind of understand this is different than your quote unquote GP versus LP. An LP is somebody that just is a passive investor who hands you a check and then they disappear, never to be seen again. And that's not what we're doing here. We're talking about setting up an active partnership where I'm responsible for doing all of the dirt work, and then the next partner is responsible for following up, and they've got a job to do. They've got to email people, they've got to get bids, they've got to review different scopes of work. So you've got to be active in the partnership, and that's not what a general partnership or a limited partner does. So again, this is what we're talking about, roles and responsibilities. I think that it's not necessarily a legally enforceable breach if I'm quote unquote responsible for handling the GC, the general contractor. While the operating agreement is a legally binding contract, and you theoretically you can sue, this particular clause about roles and responsibilities is not something that is set in stone such that I'm going to sue somebody for failing to, fully perform their management of the construction process. Instead, where we put roles and responsibilities is really kind of an aspirational general allocation of duties. Because again, if the alternative is not to put it in a signed document where both parties acknowledge it, then the alternative is basically just to have it in an email that becomes kind of lost in the shuffle. And again, it's not meant to be the basis of a lawsuit, but the alternative, I think, is very weak, and it really doesn't have moral authority to go to a partner and say, "Hey, Bob, when we did this partnership, you signed and said you would really take charge of legal. You would be responsible for handling the lawyers, responsible for the replat. You were going to do the zoning, get the certificate of occupancy, all this stuff. What's going on, man? You really kind of dropped the ball." And that can be a very powerful tool when you're working with good partners that, they care about their reputation, they care about their relationship with you guys and the other partners and everybody. And so that's what we find, because obviously, we're all in this together. Our money is in there. It's at risk with everybody. So if I'm going out of town, I can say, "Hey, I'm supposed to cover legal, but hey, Bob, can you email the lawyer back? He asked a question about this. I don't have a computer." That is 100% okay. That's expected. But in general, the person responsible for that communication, the primary contact, is going to fall on one person. And so we find that it's really, really effective for people to understand what is expected of them, as well as what the other partners are expected to do, intra-partner, is just to lay out the roles and responsibilities. And that gives you a kind of a rough idea of what people's sweat equity or what their contributions are going to be. And that leads us to our next point, which is capital. And so capital split is an important one. I tend to downplay the role of sweat equity, and I really like partners to come in with at least somewhat equal footing, or maybe not equal, but something significant on a capital contribution. So for example, I don't like a partner to come in with 0% or 5% of the equity and then in turn get a 20% lift of the project on the exit for doing a lot of work. I think there's too much of a variance between the partners. And, I'd say at the most like a 30 or 40% delta between capital contributions. Otherwise, the people are just their interests are technically not aligned. And I say they're primarily not aligned up until completion. After completion, they're aligned. But if the project is looking a little bit shaky in the beginning, somebody who has no skin in the game, no cash invested, their motivations suddenly become very different than somebody who has put down $500,000. Their actions and behavior are very different. And so capital, I think it's important that people come in. You can be somewhat equal, and then you can vary from that 10, 20, maybe 25%, but just worry about hitting too low. You don't want somebody coming in with 5% and then getting a 15% lift of the property or of the project's equity. Third topic is decision-making rules. Again, really, really critical that decision-making rules, you avoid gridlock. I think that a lot of people come to me and they say we're two equal people. We want to do 50-50 on this partnership. We're contributing equal amounts of money, but that really causes a lot of gridlock. And so that can be tough because if you have two equally smart people, they, have valid points. And I think a lot in real estate, there's not necessarily bad decisions. Should we sell for X price, or should we refinance instead? We can get attractive fixed rate debt. There's no real wrong answer, but if you have a seller that's waiting for an answer on the other side, I think the most important thing to be is decisive. And that's where decision making rules. If it's not super clear, neither side is confident enough to move forward without clear decision making rules. And if your equity decision is 50-50, no way to decide that. And, sometimes people come to me and be like, we got this offer, we need to decide really quickly. So one solution that we do for that is we break it up and do a 51-49%, because even the capital contributions there, they will tend to be very, very similar, right? If we're talking 1%, sometimes even less than that. But what it gives you is that it gives you a clear majority partner. And so again, financially, it's going to be effectively the same outcome. But between the two partners, they know that I have conceded 51% to my partner. And at the end of the day, I think they're going to listen to me. The minority, they're going to listen to me. They're going to value my input, my reasons. But at the end of the day, they own the project. They control the project, and they're going to be able to make a decisive decision quickly, often for the benefit of the project, regardless of whether it's the right decision or not, one that you may disagree with. And finally, that kind of leans over on exit strategies. But this is again where I see the most number of disputes as a lawyer. And I think Hamza was referencing this earlier, but as a commercial real estate attorney, I also get to see a lot more deals than you guys. I see more deals even than probably the most active guys, because I get so many every single day. You guys might look at a PSA once a quarter, maybe a couple times a year. I look at them multiple every single day. I look at leases every single day, and I see what tenants are saying. I see what brokers are doing. I see what lenders are offering. And so this is where the greatest number of issues come in, is kind of exit strategies. We've got a good flowing asset. We've developed it. We've leased it up. It's doing great. There's no wrong answer of whether you should sell, take your profits off the table, or you should just refinance and put it into perm debt. Increase the LTV, maybe pull out 90% of your equity, that sort of thing. There's no wrong answer, and it's all just a reflection of your investment goals. It's a reflection of your predictions for the market. But there's no wrong answer. The only wrong answer is probably to wait and get up to the end of your construction mini perm, your mini permanent loan, and when you've got less than 6 months, and then make a decision. That's probably the only bad thing. And if you notice that, it's waiting. It's that waiting period, which is the worst thing that you could do in a world of a great property that you guys have built, you've executed, you've leased it up, it's done everything, and then you kind of screw it up at the end on the exit by just waiting. And so all of these problems can be resolved with an effective partnership agreement. And so that's really kind of to the heart of it. Conflict resolution. This is a good one. So really what I think is important in this is that my experience with the conflict, they occur most frequently when there is money on the table. When a project is profitable, or when a business has money and cash flow, that's when there are disputes. When there's no money to fight over, the partners tend to just kind of put their heads down and do the job, and not necessarily argue. But when there is money, let's say when you've finished the project, when it's built, when it's cash flowing, that's when you're going to start to have issues about free cash flow distribution. Should we save this money for CapEx? Should we save this money for TIs, or for broker commissions, or maybe to develop the back half of the property? That's where there's issues, versus one investor says, no, I want a distribution. Let's do a dividend. Let's pay ourselves all this money back. And it's hard, but you have this pile of cash. How do you decide what to do with a big pile of cash? And that's where partner disputes can happen. And so, I give another example. It may or may not be relevant to you guys, depending on where you're investing out of state or where your partners are located. But two guys, start a business. One person is doing the sales. So he's flying, he's traveling a lot. And in the beginning, everybody's very scrappy. Everybody is saving every penny because they've basically spending their own money. And they're traveling, they're doing the sales, and they're away from their families. They're spending nights on the road. Anybody who's traveled for work can kind of appreciate it's a grind. It's exhausting to travel and it's tiring. But after a while, if the business is profitable and you're making good money and you could certainly afford first class tickets, staying at a Courtyard Marriott instead of a Holiday Inn. I don't know what the analogy is, but the person who is traveling at that point suddenly feels entitled, or they feel like we can afford it. I should be able to stay at a nicer hotel, versus the partner who gets to stay at home every day. The partner who hasn't suffered through that says, no, we don't need to spend that. We don't need to spend $2,500 on travel now. And it can cause a real conflict for a profitable business, for a profitable investment, that if you don't have some written policies, if you don't even have an operating agreement that says we will later agree on travel policies, we will agree on marketing expenses or comp meals, things like that. That's what causes more conflicts, is because you have money in the bank. You guys are making good money every month. How do you choose to spend that? And what is a reasonable allocation? You don't necessarily need to decide when you become partners on day one, but if you have a written agreement to say we will create a written policy a year from now, we will create a written policy on meal reimbursements 2 years from now. Those are the kinds of things that will really put it on the radar and force you guys to think about and come to an agreement about how you should spend the money that you most likely, call it more than likely, will have. And that's really, I think, a great proactive way to stay ahead of these conflicts, which partner disputes, again, we talk about buying distressed properties. Internal strife is one of the reasons people sell. Divorce, death, partner disputes is one of those things too. So hopefully you can avoid that. So I'll kind of open it up for questions now. I just try to hit on really the important things. Um, this is about the law firm. We do property transfers, purchase and sale, disposition, financing, loan document review, leases, title and survey. This is the law firm. And in particular, I invest. So I like to say my money is, I put my money where my mouth is. I say this is a great product, everybody should invest. And then I go around and I buy a few buildings and self-manage those triple net properties myself. But really, I would say that my approach as a lawyer, especially for this cohort, for people that are listening to this call, I want to give you the knowledge so that you become, I think in real estate, the contracts are so important, whether that's your PSA, whether that's your lease, LOIs, all of these documents. All of my best investors, when they're sending me contracts, they read it and they understand the nuances and they really understand what the contracts mean. Then they'll send it to me and say, Ron, we've gone through this, we approve the contract, we need you to make changes to X, Y, and Z. That's the best type of client. I like them as a client, and I think the clients, they understand the process and they understand what they can do on the contract as well as the limits and what they need an attorney to do. But it just does two things, right? It controls the timing, because if you as an investor understand what the timing, or sorry, what the amount of work needs to be done by the lawyer and what needs to be done by me as the client, you're going to be able to control that feedback process, everything, and increase the timing. And then the second part is cost. I mean, everybody's worried about cost. You have to be cost sensitive. You can't spend, unlimited funds. And so if you understand the process and you're not just writing a blank check to your attorney, that's going to be critical to controlling your budget. And it's just like with any other vendor. I don't think lawyers are special in that regard. We have a fiduciary duty. Maybe that makes us special, but we are just a vendor. We are providing a service that is a critical component. All right. Thanks, guys. Thanks, guys.
Thank you very much, Ron. Thank you. Bye.